Good morning to our lecturer. My name is CHIEW and I wish to present Case 1 Warren E. Buffett 2005. So let us start with the first question. The first question will be, what is the possible meaning of the changes in stock price for Berkshire Hathaway and Scottish on the day of acquisition announcement, especially what does the 2.55 billion gain in the market value of equity imply about the industry value of Pacific Crop? So there are three reasons. So the first will be Berkshire Hathaway market value increase. For example, the positive market reaction, strategy alignment, and synergies. Another example will be the potential earnings growth. The market might be anticipating an increase in earnings or improved financial performance due to the integration of Pacific Crop into Berkshire operation. For the second will be implication for Pacific Crop industry value. The needed for detailed analysis to determine the intrinsic value of the Pacific Crop requires a comprehensive evaluation of its cash flow, fundamentals, growth prospect, and how well it aligns with Berkshire Hathaway's long-term strategy. So the last will be market dynamics and investor sentiments. For this explanation, I would like to explain about the influence of various factors. With each elaboration is the market reactions are influenced by a wide range of factors, including investors' sentiments, expectation, and perceived future prospect of the acquiring company. Let us come to the second question. The second question is, based on the multiples for comparable regulated utilities, what is the range of possible values for Pacific Crops? What question might you have about this range? So the comparable multiple used to estimate Pacific Crops' prospective value in relation to regulated utilities. So the Pacific Crop's anticipated range of multiple in its fiduciary scenarios lies within the following bands: a PE ratio between 12s and 16s, a PB ratio between 1.5s and 2.2s, and EV and EBITDA range between 8s and 10s. The factors need to consider within the valuation range. The first will be financial metrics and performance. The second, regulatory environment. The third, geography and market factors. And the fourth, future growth of prospect. The fifth will be the risk adjustment. So this is the next question, question 3. Assess the bid for Pacific Crop. How does it compare with the firm's intrinsic value? As an alternative, the instructor could suggest that students perform a simple discount cash flow analysis. So for my answer is, assessing for the bid of Pacific Crop involves a comprehensive evaluation of its value. Utilizing the market multiple method, we conclude the company's valuation based on its EBITDA and average industry multiples. The calculated values range from 9,017 billions to 9,017 millions, closely mirroring the bid's 9.4 billion offer. This alignment suggests the bid that value is in the line with Pacific Crop market-driven valuation. Furthermore, when examining the Pacific Crop's intrinsic value range, as displayed in Exhibit 10, it spans from 6.252 billion to 9.289 billion, again indicating that the bid closely matches the company's intrinsic growth. Additionally, a discount cash flow analysis was performed, resulting in an enterprise value of 9.26 billion, further substantiating associating the BRICS Congress with specific value. In summary, multiple valuation approach converge to suggest that the offer bid of 9.4 billion is reasonably aligned with Krop's intrinsic and market-driven values. So for the question 4 is, how well has the Berkshire Hathaway performed? How well has it performed in the aggregate? And what about its investment in Mid-American Energy Holdings? So for my answer is, Berkshire Hathaway, established in 1965, which has consistently outperformed the market with an impressive average annual return of 24% by 2005. Over a 14-year period, it exceeds the average yearly gain of 10.5% for a major corporations. Berkshire Hathaway Class A share price at 102 per share in 1977 surges to an astonishing at $5500 for per share by May 24, 2005. Furthermore, its investment in Mid-American Energy Holdings proved lucrative with substantial growth in net operating revenue and EBITDA from 2000 to 2005 year. This success was enabled by Berkshire Hathaway ownership of 9.9% of voting rights and 83.7% economic stake in Mid-American, allowing effective management in the face of utility regulations. 5. What is your assessment of Berkshire's investment in Buffett's Big Four, American Express, Coca-Cola, Gillette, and Wells Fargo? So here I provide a figure 1 for you to have a look, and I will explain for this figure. The Big Four firms comprise American Express, Coca-Cola, Gillette, and Wells Fargo. Berkshire's investment in the Big Four is a wise investment decision. They put money into companies that were already well known and doing well. Based on the figure 1, the first, American Express Company, Berkshire Hathaway owns 12.1% of American Express shares. The market value of American Express was $8.548 billion, and the cost of investment was $1.470 billion. The second, the Coca-Cola Company. Berkshire Hathaway owns 8.3% of Coca-Cola shares. The market value of the Coca-Cola was $8.328 billion, and the cost of investment was $1.299 billion. The third will be the Gillette Company. Berkshire Hathaway owns 9.7% of the Gillette shares. The market value of the Gillette Company was $4.299 billion, and the Berkshire invests $600 million in the company. The last will be the Wells Fargo and Company. Berkshire Hathaway owns 3.3% of Wells Fargo shares. The market value of the Wells Fargo Company was $3.508 billion, and Berkshire invests $463 million in the company. The question is from Warren Buffett's perspective, what is the intrinsic value? Why is it accorded such importance? How is it estimated? What are the alternatives to intrinsic value? Why does the Buffett reject them? So my first answer is, Warren views intrinsic value as the increase in value per share calculated as the discount value of anticipated future performance. investment strategy focus on undervalued stock to achieve the best return. 7. Critically assess Buffett investment philosophy. Be prepared to identify points where you agree and disagree with them. So my answer is Warren Buffett investment philosophy revolves around value investing, a long-term perspective, and a focus on quality companies. Here's a critical assessment on his philosophy based on his 2005 case study. The first agreement is focus on simple business. Buffett prefers companies with straightforward business model, making it easier to assess their value and prospect. The second will be emphasis on competitive advantage. Buffett investigates where a company has a durable competitive edge that can protect its profit, a crucial component of its strategy. The third agreement is disciplined approach, a long investment horizon. Buffett patience and discipline in waiting for the value of strong company to be realized in their stock price are admirable. For my disagreement will also be 3 points. The first will be reluctance to invest in high growth tech stock. Buffett tendency to avoid tech stock means he missed out on many significant opportunities such as Amazon, Netflix, or Google. The second will be singular focus on US-based company. Most of Buffett's stock investments are in US firms, limiting his exposure to global opportunity. So last but not least, the third disagreement is large cash balance in later years. Buffett has allowed Berkshire Hathaway cash balance to grow significantly, indicating a lack of investment confidence and decisiveness in his later years. Should Berkshire Hathaway shareholders endorse the acquisition of Pacific Crop? My answer is Berkshire shareholders should consider endorsing the acquisition of Pacific Crop for several reasons. The first will be alignment with Berkshire investment criteria. Pacific Crop is a simple, predictable business with strong earnings, return on equity, and low debt levels. It fits well within Berkshire's preferred investment profile and acquisition strategy. The second will be growth opportunities. Pacific Crops operates in regions with projected population and electricity demand growth. Acquiring Pacific Crop positions Berkshire to benefit from this future growth, potentially increasing utility earnings over the long term. The third will be sector expertise. Berkshire has successfully operated the utility Midterm American Energy, demonstrating its ability to manage utility effectively. Their knowledge of the sector will aid in efficient operation. The fourth reason is attractive valuation. The market value gain for Berkshire upon the deal announcement suggests that Pacific Crop is being acquired at a reasonable, likely discount price in line with Berkshire's history of value-based acquisition. The last but not least, portfolio diversification. Pacific diversifies Berkshire holding into a new geographic region and business sector, reducing overall investment risk. In conclusion, Pacific Crop aligns with Warren Buffett's investment philosophy of making long-term investment in quality company at reasonable price. The acquisition is consistent with Berkshire's proven criteria and provide opportunities, growth, and diversification.